Welcome to the Explainer. Today, we're going to break down the 5 essential rules for successful stock investing.
You know, it's the question that keeps every serious investor up at night, right? How do the legends, the absolute best in the game, manage to win consistently, not just for a year, but for decades, without getting sidetracked by all the noise and panic in the market? Well, the answer might surprise you. It has nothing to do with some secret formula or a hot stock tip. It's all about having a set of simple, timeless rules that you follow with absolute discipline.
For everyone who's been following along, welcome back. This is Class 9 in our ongoing series about making smarter investment decisions and building real wealth. And hey, if you're new here, that's great too. You can catch up on all the foundational stuff in our Investment Decisions playlist. Today, we're going to pull everything we've learned so far into one powerful, practical framework you can actually use.
And trust me, you are definitely going to want to stick around till the very end. We're going to boil all of this down into a single, super practical 6-point checklist. It's something you can literally use for every single investment you make from here on out. It really is a game changer.
Okay, let's look at the roadmap. First, we'll build the foundation, which is your personal investment philosophy. Then, we'll get to the really fun stuff, how to spot truly great companies. And, this is key, how to pay the right price for them. After that, we'll talk about the incredible power of playing the long game and the totally underrated skill of knowing when to sell. And of course, it all leads up to that investor's checklist I just promised you.
So, first things first. Before you even think about clicking the buy button on any stock, you've got to have a philosophy, a framework. This is your North Star, because without one, you're just a ship without a rudder, getting tossed around by every news headline and market whim. And that, my friends, is a surefire way to lose money.
I just love this quote. Someone was supposedly overheard saying this at a Warren Buffett meeting. They were complaining that Buffett was boring because he says the same thing every year. But you see, that's not a bug. That's the entire feature. The secret to his unbelievable success isn't some brand new, complicated strategy every year. It's the complete opposite. He has a core philosophy and he sticks to it with relentless consistency. That discipline, that refusal to get distracted, that is the superpower.
All right, so with that philosophy locked in, how do we actually go about finding these amazing businesses? Well, it all starts with 2 really simple but incredibly powerful rules. Rule number 1, do your homework. I know it sounds so obvious, right? But you'd be shocked how many people just skip this. You have to understand the business you're buying inside and out. And when you do that homework, it leads you straight to rule number 2, find the company's economic moat.
So what on earth is an economic moat? The image is perfect. Think about a giant medieval castle. What was its number 1 defense? A big, wide moat filled with water. It kept the bad guys out. In the world of business, an economic moat is a durable competitive advantage that protects a company's profits from being attacked and eroded by competitors. It's like an invisible force field that separates a pretty good company from a truly great investment.
Okay, finding a castle with a huge moat is awesome, but it's only half the battle. You still have to buy it at a good price. And that brings us to rule number 3, which is an absolute non-negotiable for smart investors. Always, always insist on a margin of safety.
So, what is a margin of safety? It's really simple. It's the gap between what you calculate a company is actually worth, its real intrinsic value, and the price you pay for its stock on the market. Now, why is this so critical? Because let's be honest, the future is unpredictable, and sometimes our analysis is just going to be wrong. This margin of safety is your financial cushion. It's your safety net that protects you from your own mistakes and, frankly, just plain old bad luck.
And this is a brilliant way to think about it. Your margin of safety isn't some fixed number. It's totally dynamic. For a super stable, predictable business, like a Walmart, you might feel comfortable with a smaller discount. But what about a company in a really unpredictable industry, like teen fashion? Think Abercrombie & Fitch. For a business like that, you'd need a huge discount to its value to make it worth the risk. It's simple, really. The shakier the company, the bigger your safety net needs to be. Okay, you found a great company, it has a wide moat, and you bought it with a margin of safety. So, what now? Well, now comes rule 4. And this might be the single most powerful wealth-building tool there is, yet so many people ignore it. The rule is simple. Hold for the long haul. Why? Because constantly trading in and out is a loser's game for almost everybody. Let me show you exactly what I mean. To really see the difference this makes, let's meet 2 imaginary investors. Over here we have long-term Lucy. She invests $10,000, and she patiently holds on to her stocks for 5 years at a time. Because of that, she pays the much lower long-term capital gains tax. Then you've got Trader Tim.
He also starts with $10,000, but he's hyperactive, trading his entire portfolio 2 times every single year. All that trading means he gets slammed with higher short-term capital gains taxes on every profitable trade. Now, for the sake of argument, let's say they're equally brilliant investors. They both get a 9% annual return before we factor in any costs or taxes. What do you think happens after 30 years?
Well, the results are, they're just staggering. It's not even a competition. After 3 decades, once you account for all the taxes and trading fees, Trader Tim's $10,000 grows to a measly $31,000. But long-term Lucy, just by being patient and tax-smart, her portfolio balloons to $93,000. That is literally 3 times more money, and all she did differently was play the long game.
And here's the real kicker. For Trader Tim to have ended up with the same $93,000 as Lucy, he would have needed to be a certified investing genius. He would have had to generate an extra 5% in returns every single year for 30 years straight just to break even with her. That's an almost impossibly high bar to clear. The lesson couldn't be clearer. Patience pays. Big time.
So, holding for the long haul is absolutely key. But buy and hold forever isn't always the right move either. And that brings us to our 5th and final rule. You've got to have a disciplined, rational plan for knowing when it's time to sell.
Now, before we talk about the right reasons to sell, let's get the wrong ones out of the way first. You should never, ever, ever sell a stock just because the price went down. That's called panic selling, and it will destroy your portfolio. But here's the one that trips people up. You also shouldn't automatically sell just because the price has gone way up. Why? Because what the stock price did yesterday tells you absolutely nothing about where the business is going tomorrow. And the business is all that matters.
Instead of reacting to the market's mood swings, your decision to sell needs to be a calm, rational process based on this 5-question checklist. You ask yourself, number 1, was I wrong? Did I make a mistake in my original analysis? Be honest. Number 2, has the business itself gotten worse? Have the fundamentals actually deteriorated? 3, has the stock price gone completely insane and shot way past what the company is actually worth? 4, do I see another opportunity that is clearly significantly better for my money right now? And 5, has this one stock just grown so big that it now represents a dangerously large chunk of my entire portfolio? If you can't say yes to at least one of these, you just hold on. These are the only good reasons to even think about selling.
So there you have it. We've covered the 5 core rules, from building a philosophy all the way to knowing when to exit. And now, just like I promised, it's time for the big payoff. A simple, practical checklist that pulls it all together.
All right, this is it. Go ahead and take a screenshot. This is your 6-point sanity check for every single investment decision. Number 1, have a philosophy. 2, do your homework and understand the business. 3, find that wide economic moat. 4, demand a margin of safety. 5, play the long game. And 6, know the only valid reasons to sell. If you can truly internalize this checklist and apply it with discipline, you will be miles ahead of almost everyone else in the market.
And that brings us to the end. So after seeing these core rules laid out, the final question isn't for me, it's for you. Which one of these rules represents your biggest opportunity to get better? Are you not doing enough homework? Are you maybe not demanding a big enough margin of safety? Or is it just having the patience to hold on for the long term? Figuring that out for yourself, well, that's the first real step on the path to becoming a truly successful investor. Thanks so much for watching.